Hello and welcome everyone. Happy Friday. We have made it through another week. We are ready for another lesson before we get to another weekend. The past two Fridays we've talked about the topic of the Federal Reserve, the federal interest rate, and then last week we talked a lot about interest rates, what they are, how they're charged, and how simple versus compound interest works. The one thing we didn't talk about is how all of that applies to one of the most common ways that people like you and me will encounter interest rates: mortgages, auto car loans. Anytime you're borrowing money, whether it be to buy a house, a car, or even your credit card, you can encounter, and you likely will encounter, interest rates that are not labeled as interest rate. Instead, they have these magical three-letter words: APR, APY, or ARM. So today, I want to talk with you all about those three terms: APY, APR, and then to a lesser extent, ARM, so that by the end of this webinar, everybody will know what those mean, as well as they have a little bit more information about how those numbers may not be telling you everything that you deserve to know and that you should know. So, before we get to today's presentation, if you're watching this live, thank you all so much for being here. If you're watching this recorded, we do these webinars live every Friday at 7 p.m. Eastern, 4 p.m. Pacific time, and you can join us at the Sectors Made Simple YouTube channel. But as is tradition here, I always like to say hello to all of the people we have live with us in attendance as I bring more light. So, hello to Blaze, Lucia, MB, Contacto. I'm just going to call you Laura from now on. Andrew, Maria, Iris, Leticia, Eddie, Kira, Felipe, Ernestina, Anna, Melly, Magnolia, Andrea, my mom, Ricardo, Chelsea, WC, Jorge, Desert Rose, Janice, Kike, Maria, Ingrid, Jacqueline, Neri, Rina, and Lily. Good to see you all. My dad's here? Oh, and my dad, and Alex, and Raul. So many great faces. Thank you all so much for being here. Let's get to today's topic, which is all about the lovely topic of APR and APY. So, I'm going to talk today a lot about something that you will have to deal with. We don't like to deal with it because it's ugly and scary numbers, but we need to. But with all of that said, because we're talking about something in the real world is never as simple as what I could tell you in a 1 hour long presentation. So, necessary disclaimer for this one. Today, I'm going to talk a lot about APR and other interest rates as they apply in the real world. Because of this, while I do everything I can to make sure that the information is as up-to-date as possible, I don't use old information. Everything I gather for these webinars, I do immediately so that all of the information is fresh and is correct. But exact numbers as well as conditions can vary, because this is real stuff. These are real interest rates that you will encounter, and I can't give you all of the little terms and conditions apply, as you'll see later on. There's no simple answer when it comes to interest rates, so please take everything I'm teaching today here as educational purpose. I'm explaining this to you so that you are aware of what these terms are, but prior to making any financial decision when it comes to accepting a loan or getting a new credit card, please always make sure you do your own research. You shop around to see different rates and different providers. Or, and probably the most correctly, consult a professional, either a tax professional or a financial planner, in order to find the correct solution for you. But with all of that said, today's webinar is all about teaching you these terms so that we demystify, we define something that you will encounter so that you don't just look at it and either say, I don't know what that is, or say, oh, that's a nice number. you need to understand what these numbers are. So that's why I'm here today. So with that said, let's get right to the good stuff. So let's start off by first talking about what APR actually is. APR it's an acronym where every letter stands for a different word. That stands for annual percentage rate, APR. And an annual percentage rate is a type of interest rate that's oftentimes used by banks, credit card companies, lenders, anyone that either holds your money or gives you money. They're going to use this word, APR. But APR is not the same as the interest rate that you are charged. APR includes additional fees, additional costs, one-time payments, anything that is not just the money you're borrowed and then the interest on that is lumped into APR, because it's important to know what fees and costs you have in addition to just getting a check for $200,000 whatnot. But exactly what fees and costs, it's not that easy, because it depends on what they want to tell you. And as much as I would love to think that large financial institutions have our best interests at heart, they're businesses. They're run like businesses, and it's the same reason that if you go to a store and you want to buy something that costs $1, it's not going to be $1. It's going to be 99 cents. It's the same cost. It's a cent less than $1. But in your head, seeing that 1 cent difference from 100 cents or $1 to 99 cents makes a massive, massive difference in the amount of people that will actually buy that thing. So why tell us more information than they need to? They're going to do what they have to by the law. So we're going to talk about that law a little bit more, exactly what it is they need to tell us and what they kind of try and leave out. But why does APR even exist? Why can't we just say interest rate? Well, when you get a loan or a line of credit or any form of buy now, pay later, there are oftentimes fees that you have to pay. And these fees aren't just the interest that you get charged. They're oftentimes in addition. And because there's this difference between the fees, that's usually a flat amount of money, or the interest and the principal, which is it gets crazy. So because this can become, this can become so misleading, the US government stepped in and wrote some laws in order to try and regulate this lending industry. And there's two that really come up, and we'll talk about one right now, which is back in 1968, the US Congress passed the Truth in Lending Act, the TILA, which requires all lenders to list their APRs. So what that means is when you go to a bank and you say, I want to borrow $200,000, they are legally required to not just provide you the interest rate that you will be charged, but they are required to provide you the APR as well. But it's not that simple. And this line of "it's not that simple" is going to come up many times today. And that's why that disclaimer is so relevant. It's so incredibly important that you realize that we're going to go through the simplest form of all of this. But by simple is often still a 25-page packet that you're going to get. And somewhere on page 6, it's going to say the APR. But how is APR actually calculated? Well, that formula is pretty easy. It's this. We have the number of days in the year times 100 to turn it into a percent. And then the actual magic happens where we take the fees, add it to the total amount of interest, divide that by the loan amount, and then divide it by the number of days in the loan term. And now we go back to it's not that simple. This formula is how it's taught in the math books. It's how it's taught in pre-calculus. It's how I can teach it to you. But in the real world, this formula doesn't work because it's not going to give you the correct numbers, because this little fees thing up here is complicated, to say the least. If you try and plug in numbers into this formula, it's not going to work. So that's why we have calculators. There are online programs that are completely free to use, and I will show you one at the end of this webinar, that lets you find the real APR numbers without needing to do the math yourself. It's not that you can't do the math, it's that the math won't work, because none of this is as simple as any of us would like it to be. But why is it not simple? If this APR is supposed to help consumers, help you and me, to find rates simpler, why is it still not simple? Back to that fees word. The word fees is not very easy to define here, because while the exact fees you're charged will vary, it'll depend on the type of credit or the type of loan, the time in which that fee is paid also matters. Lucia, do you think Excel has the template with the formula? It does, but again, this term fees is really difficult because the APR calculation here takes in and says, we're going to take the value of the fee Sorry about that. All right, let me start over by what I was answering Lucia's question with. So there is a Excel formula that you can use for APR, but it's not going to give you the correct answer for whatever question you're going to ask it. Nor, funny enough, will this formula, because it all comes down to how these fees are paid and if they are amortized out or not. Amortized out, or amortization, is the idea of taking one big payment and chopping it up into lots of little bits. APR amortizes the amount of those fees and the interest evenly across the entire duration. In a longer term loan, the amount of fees will have a much larger effect than a shorter term loan. So the formula, yes, it exists, but I will tell you from experience, the only way that I've ever gotten APR to be correct is by using the online calculators. So that's why, again, I'm going to show you that, because it's hard to do this kind of math on paper. There's so much fine print that it's almost impossible for us to do it on paper. But again, why is APR not so simple? Because fees is not easily defined. And not just that, the exact fees that you are charged will depend. So here are some of the most common fees that you can expect to see if you ever take out a line of credit to buy a house, a car, to go to school if you need student loans. A lot of these fees will apply, and they are brokerage fees, which is the fee that is charged to actually buy the house. The transaction fees, which is the fee that you have to pay to actually make the transfer. Mortgage insurance, application and processing fees, so to actually fill out all of the paperwork and to process all that paperwork, to hire a person to transport those papers from point A to point B, any legal fees that they need to spend on a lawyer to write up the documents, an underwriter fee, which is them making sure that you can pay, and then closing costs. And this is a short list. There is plenty more, and the exact list will depend, and the exact things that they include will depend. That's why it's always important to read the fine print. And you may think that's a lot, but much like Billy Mays, there's more, and they aren't included in the APR. So here's a list of fees that you may be charged when you get a loan that aren't included in your APR. Title fees, so the cost of actually changing over the deed of the property or the deed of the car to your name. Property surveying fees, if you need to have lines drawn to see where your property is. Document preparation fees, that's pretty similar to the processing fees, but slightly different, so these ones aren't included. Notary fees, the fees to have someone look at you, sign your signature, and say, okay, yep, that's Jonathan. Checking your credit, checking for pests. All of these are not included in APR. Some may include it, most won't. So it's always important to actually go through every single line to see what is and is not included in your APR. Now, we've talked a lot about the fee part, but let's now go and take a look at the interest rate part and see how those two work. Hi, Olga. Good to see you. So APR and interest rate is weird because they both work off of the same thing. So when you're shopping for a loan, which means shopping for a loan is just another way of saying, hey, Bank of America, what's the best you can offer me? Hey, Schwab, what's the best you can offer me? Hey, Mom, what's the best you can offer me? Going to all of the different people that can lend you money and seeing what they would charge you to borrow that money. But how does that actually relate to your interest rate? That rhymes. Your interest rate is the amount that you have to pay based on the amount of money that you borrowed. And oftentimes, these interest rates are calculated monthly. So what that means is after the first month, even though APR, annual interest or annual percent rate, we're talking here monthly changes. So what will happen is when you go and you pay your monthly bill to whatever it might be, they will then add on the interest every single month. The amount of interest is based on the amount that you owe. Most, and I use that word very carefully because it's not all, most loans and mortgages, they are weird because they don't charge you it's not compound interest. We talked last week about compound interest. It's like your drips. You have money in an account, it gains interest, and then that interest gets put back into the account. Bank loans often work differently. The amount of interest you owe is charged monthly, but the amount of interest is not added to the principal, which means that as you pay off your interest, you don't have to now pay interest on the interest. You only pay interest on the amount that you still owe. Again, that's very, very strange because it's kind of simple interest, kind of compound interest, but think about it like this. Every month, I'm paying my bill, so the amount that I owe goes down. The amount that I owe goes down. The amount of interest that I now have to pay also goes down. I do not need to pay interest on that interest. Instead, I only pay interest on the amount that I borrowed. So that's where this whole monthly calculation comes in. But again, I just talked about how there's this craziness that happens where it's kind of compound interest, but kind of not really. So to make things simpler, that's why APR is here, is because instead of telling you what the monthly interest rate is, instead what they do is they tell us the annual rate. And that annual rate includes the fees and also includes the payment plan over the entire duration of your loan. So here we know for sure how much every single year we will have to pay in interest. And this APR will include the monthly interest rate plus any fees. Now, I've talked here quite a bit about the fees, and I've made them to sound like they're these really scary things. Because most of the time, they add on to how much money we need to spend, either later on, if it's tacked on to the loan, or immediately, which is a lot of money. It can be $10,000 when you buy a house. Just gone. Closing costs alone, $10,000. Poof. But are all fees bad? No. But they do still affect the APR. So one fee that I want everyone to be aware of, because it's one of the largest parts of shopping for a loan, is this idea of points. When you shop for a loan, there are two main things that you should be looking at. The interest rate they charge you, or the APR, as well as if there are any points. Points are a percent of the mortgage amount that you pay up front. So if you have 1 point, you pay 1%. So if you have an $100,000 loan, you pay $1,000 up front. But this isn't just money that's been thrown away. Instead, this payment is then put towards your interest. Again, you take the amount that you owe, and points are a percent. So if you have 2 points on an $100,000 loan, you have $2,000. But that's not $2,000 that you just throw away. That's $2,000 that are put towards your interest payments. And because you are prepaying your interest, it actually lowers the overall APR. On average, each point that you pay up front will lower your APR by about 0.25%. But remember, and this is where that whole slide about APR versus interest rate comes in. this does not affect your interest rate. Your interest rate is your interest rate is your interest rate. All this will do is it lowers your APR, because now instead of having to pay, let's say, $100,000 in interest, you already paid $2,000 of it. So now you're only paying $98,000. So again, each point on average will lower your APR by about 0.25%. Lucia, so we pay interest on the fees and the interest on the principal. So it depends. You have the option to pay the fees yourself. And if you pay the fees yourself, while they do contribute to the APR, there is no amortization of those. You're not charged interest on those fees. It's just flat. Otherwise, if you choose to add the fees to the loan amount, then yes, you will also be charged interest on that money as if it were part of the loan. But again, your interest is always on the principal. You do not pay interest on the interest, unless, of course, you have late penalties. And I'll discuss those here right now, actually. So we just talked about loans and mortgages, but where else in the world do we see APR? Because it's not just when you buy, or it's not just when you're borrowing money. Credit card companies, which I guess is also a form of borrowing money, will also use the term APR to give you different rates, or not really give you rates, but tell you the different penalties that they will assign you. So there's 5. The first one is called the purchase APR. This is interest that is charged on credits that are not paid off in time. So your credit card may work where you have a purchase APR of 30 days for 5%, which means you have 30 days to pay off. Say you bought McDonald's on the 1st of April. You have until the last day in April to pay off that McDonald's bill. If you don't, they charge you the purchase APR rate, 5% maybe. So now they charge you 5% interest. A balance transfer APR, where you transfer an amount that you owe from one card to another. Or if, for example, you have an introductory APR. This is a period of time that, credit card companies, they want to bring you in. They'll say 0% APR for the first 24 months. What that means, they don't charge you any interest or any late fees for the first 2 years. Not bad, right? Wrong. Because at the end of those 2 years, they then change your account and that balance transfer thing happens. So any money that you owe there now gets assigned the balance transfer APR. Contacto is saying, what is a good APR? That is a great question. It depends on the federal interest rate. For example, right now, the federal interest rate is incredibly low, so it's very possible to get a conforming loan, which means good credit, not a crazy amount of borrowing, high chance to pay it back, the best rate you're really going to get. That preferred rate is going to be somewhere around 2.7% interest rate. How that translates to APR is likely going to be in the low 3s, but we'll go take a look at that together when we go and do the APR calculator. But again, a lot of the reason that APR is higher than the interest rate is those fees that we can't avoid. So it's important to know how much those fees will cost us. Lucia, I transferred to another account that has 0%. However, I paid the 3% for the balance transfer. Yep, there's no such thing as free money, and I wish there was. If there was, well, I guess there's a money tree, but it doesn't really print money. It just gives me leaves. But that's what an introductory APR is. The introductory APR is it doesn't print money. It's not a money tree, okay? The introductory APR is a period of time that 0 APR is given. But after that, they'll usually charge you the balance transfer APR. The next one is called a cash advance. Did you know that you can actually withdraw cash from your credit card? You can, and they charge you for it. How much? Check the cash advance APR rate. That is where they will tell you. APR rate is redundant. But cash advance, that's how much they charge you if you ever want to withdraw $100 from your credit card. And then the last one, and probably the scariest one, is the penalty APR. If instead of having purchase APR, you have penalties, which is if you don't pay your monthly credit card bill on time, they will charge you the penalty APR, which is an amount that you will now have to pay in interest because you didn't pay off your bill in time. So, we've now talked all about all of these crazy different ways that this annual percentage rate will be seen. There's also another very, very, very similar term called the annual percentage yield, APY. So, let's talk about what the APY is now. Romulo saying, all of this is too complicated. When we bought the house for the first time, we did not have a choice to accept the terms. That's exactly why I'm doing this topic, is because you're not going to be able to master it the first time you see it on a slide. But all I want to do is to show you that these exist. So if you ever see the words APR, APY, or anything like that, you know what's going on. You know what those mean, and you know the difference between the interest rate, between the APR, and where somewhere in the middle is how much you're really going to end up getting paid, or you're going to end up getting charged. We can't avoid all of this. We need to play their game because every organization will do it. The best thing we can do is have the information that's in these slides to prepare us for when we go in there. We can say, all right, well, I'm going to go next door and see what they will offer me. Kike is saying some are up to like 29% if you're late. Yeah, credit card late fees are ridiculous. Absolutely insane. All right, let's now go and let's move away from the interest rates and APR and talk about the yield, actual dollars and cents. So we just talked about APR, but what about APY? APY is similar to APR, but instead of annual percent rate, it is the annual percentage yield. Yield is not just going to a traffic stop and having to look both ways before you cross. We're talking about here how much you get in return. So APY applies to compound interest loans or accounts. Remember how I said before that APR is weird because it's kind of compound interest, but not really compound interest? Here's where that comes in. APR is typically fixed. The APR, the reason we have it is it's the one number that is just going to be straight through the entirety of its existence. It's supposed to stay the same. So an APR of 5% will not change from 5% for the entirety of the loan, or so we hope. APY can and will change as the principal changes due to compounding. Again, compound interest is something we covered in last week's webinar. So if you want a refresher course or if you want to learn more about compound interest, I recommend you go and take a look at last Friday's webinar on interest rates, where in very similar fashion, we talk all about simple versus compound interest. But to illustrate APR versus APY a little bit easier, let's do an example. All right, we're going to go back to my good buddy Juan. And Juan de los Palotes has his savings account that has a 6% annual percent rate compounded monthly. So again, APR is an annual rate, but it doesn't mean it's not compounded faster. Just like when you get a 4% APR from your bank, they still compound your interest monthly, whether you like it or not, honey. So it's important to know where APY comes in here. So after every month, the interest is calculated and added back into the account. So APR will come out to, if we have 6%, we divide it by the number of months. So 6 divided by 12 months in a year is 0.5%, 0.5% per month. So if Juan had $100 in his account, he would gain 0.5% interest after every single month. So after the first month, if he had $100, it would give him 50 cents for a total of $100.50. But now, the next month, Juan now gains 0.5% interest on $100.50 instead of just the 100. So now let's look at what that would look like from month 1 all the way down to month 12. If we look after 1 year, here's what we end up having. Month 1, he starts with $100. He gets paid out 50 cents in interest, so the APY amount and the APR amount are both the same. Keep in mind, the APR amount is always going to be 50 cents. It's 0.5% every single month, 12 months in a year. You'll end up with 6% return after the first year. For APY, it compounds. So here we see 50 cents. Now the amount that he gets paid is still 50 cents. But then the next month, it's 51. Then 51, then 51, then 51. There's a bunch of little decimal places, though, that you don't see here. I just rounded off to the nearest cent. But we see that amount is going up and up and up and up and up, where by the end of the first year, instead of having 6% return, his yield is 6.17%. Or if we did it out every single month, 0.5. 6%. And then the APY percent ends up being a little bit higher at 6.17%. So we see two different numbers here. One that is based on the percent rate and one that is based on the percent yield. So which one is correct? Both. There is no right or wrong answer here because both are correct at telling you what they're supposed to tell you. But banks and lenders, they're not going to give you all of the details. They're not going to sell you something for $1. They're going to sell you something for 99 cents because it looks nicer. They're going to advertise to you Whichever number is more appealing, whichever number they like more, whichever number will make them more money. But within reason, because good old Uncle Sam was looking out for us. And to avoid banks from being super, super secretive and almost deceitful, the U.S. Congress passed the Truth in Savings Act of 1991, which requires all lenders and banks to list both APR and APY. Now, you're not going to see that on an advertisement. The only time that you will see both the APR and the APY is when they put the contract in front of you and say, all right, just sign on the dotted line there and we're good to go. It's not going to be on the ad. It's not going to be on the billboard. It's not going to be in their office. The only way to know what both the APR and APYs are to read the fine print, to ask them directly, or to read through the entirety of the contract that they give you when you go to either open that account, complete that loan, whatever it might be. So we do have the Truth in Savings Act, as well as we have a little bit more regulation as to what is going to be in APR. But even with this, there are still some factors, such as how these upfront fees will be charged when it comes to actually calculating the APR. Lucia is asking, just curious, do you read the fine print? It depends on what I'm reading. If I'm buying something that is just, it's health hazards or anything like that, for example, in the state of California, anything that has a lithium-ion battery, a lead-acid battery, anything that could have a chemical that is harmful needs to have a giant disclaimer on it. So, do I read all of the fine print? No. I read the fine print when I'm doing something that requires me to know everything, where it's not just I've bought it and now I own it. It's I'm going to be making regular payments to something. I'm subscribing to something. I am borrowing something. Understanding, especially when it comes to borrowing, the terms, the length, so the rules of the thing, basically, but also what condition it needs to be in when I give it back. For example, if you lease a car, what condition does it need to be in? What about scratches? What about anything like that? Or any time that I'm getting a loan or getting a payment plan for something. How much do I owe? How long? Can I pay in advance? What happens if I miss a month? What happens if I'm a few days late? For example, that's a great one. If, things happen in real life. If I'm late to make my payment on my mortgage, the bank isn't going to call me up the next day and say, hey, we're now charging you 30%. They give you 7 days to correct it. So you have until 7 days after when the payment is due before they charge you interest, as well as before they report it to the credit agencies. So understanding the fine print is important, but it really depends on exactly what you're signing. For something simple, reading the fine print's not necessary. For borrowing money, opening a bank account, or any financial account, it is very, very important to read it. For example, last example, I promise. If you open up a investment account and you say that you're not a day trader, when you go and you say, I've read and accept the terms and conditions, one of those conditions is that you're only allowed to trade a certain number of times per week or a certain amount of times per day. You can't buy and sell the same thing within a certain time period. There's a lot of rules that are different for day traders as opposed to the average investor. So understanding what those terms are is incredibly important because it determines how they consider your account as well as if they charge you to make these transactions or not. So, long answer, but it's a very great question. But going back to APR and APY, Laura is saying, so the higher APR, or sorry, the higher APY is better for us, right? Yeah. If it's a savings account, the higher APY is better for us. If it's a loan amount, you don't want the higher APY. That means that you're just getting charged more money. But do you remember that formula that I showed us in real life, or earlier in the presentation, that I said ignore it? It's because with all of these front fees and all of that, it's pretty useless. It's not going to give you the best answer or the most real answer. So now I've talked quite a bit about APY as well as APR. But there's one more term that I want to make sure that I cover. Not in a crazy amount of detail, but enough that so you know it exists. ARM. ARM is another way that banks and lending institutions try and mess with the APR and make it seem better than it really should be. ARM, which stands for Adjustable Rate Mortgages, are loans that will have a fixed interest rate in the beginning. So calculating APR is very, very easy. But after that fixed period has passed, the rate can change and will change. It's not that the bank all of a sudden can cheat you out of money and say, all right, the rate is now 50%. They don't really get to choose what the rate is. The rate tracks an index. And how that index does will determine what that new rate is. But the period of how often the rate changes and how long the fixed period is important. And that is up to the bank to determine. But ARM rates are listed like this. It will be a number / number ARM. The first number is how long the fixed rate is for. The second number is how often from there on out the rate changes. So say we have 5 and let's start 1 and 10. So 1-10 ARM. That means that you have the fixed rate for 1 year, and then from there, every 10 years, so 1-10, 1 year fixed, every 10 years, the rate will then change again. You could have 5 and 5. For 5 years, the rate is fixed, and then every 5 years from there on out, the rate changes. Or it could be 2 and 30. You have 2 years of the fixed rate, and then 30 years, every 30 years, the rate will change from there. But again, APR relies on fixed interest rates. That's the whole point of APR. It's to tell you over the entire duration of that loan, what is the average percent you're charged per year. So ARM can greatly change the real amounts that you pay, because if that interest rate goes up, the APR doesn't know what the interest rate is going to be in the future. So as soon as the rate changes, your APR useless. And you don't really get a say in how it changes or what it changes to, or if you even accept the new rate. You're along for the ride. So ARM is something that has its uses, but in most cases, if you are looking at APR or shopping around for different APRs, anything that includes an ARM will make APR almost useless in determining how much you will pay over a period of time. I've talked a lot, but I want to show you what these look like in real life and how that whole thing that I was saying about always do your research is more important than anything when it comes to something like this. Let's go and look at some examples. For legal purposes, I will just say this webinar is for educational purposes. I am using all of these ads in fair use, so let me show you these examples. Historically low mortgage rates, as low as 3.389% APR. Asterisk. Some terms apply. And then it says, for a 10-year term. What happens if you don't want a 10-year? What if you want a 30-year? That goes up to 4%. So, yeah, you get 3.389%, but if you want a 30-year loan, boom, 4%. Sorry, just how it works. So, the length of the loan will change the APR. It doesn't change the interest rate, it just changes the amount that you will have to pay in interest. It will increase the overall interest amount, and as a result, will increase your APR. I could be a professor in college. You know, I enjoy this. I enjoy getting to create something and then create context around it. You know, going back and being a professional student wouldn't be the worst thing ever. That's the fun of this. I love learning and sharing my education alongside all of you. But here's another example. This one is for a credit card. 3.645% variable APR, assuming home equity. All right. Variable APR. The APR will change. So this rate is something you are only getting for a period of time. How long? They don't even tell you. Here is an ad for a car. 1.9% APR financing for the first 60 months. If you don't pay off your car in 60 months, congratulations, that rate's going to go up. To what? No one knows. It's in the fine print. And I'll tell you what, it's not in this fine print. You can't see it in this screenshot, but I've read it. It's not in this fine print. So good luck going and finding what the APR rate will go up to after those first 60 months. How about a interest yielding certificate deposit, CD? We talked about those last week. 0.25% APY, 9-month. 0.35% APY, 14-month. Asterisk, which means some conditions apply. What conditions? We don't know. They don't tell us. And I'm not cutting off the ads, by the way. I'm not hiding the fine print somewhere. It doesn't give you the fine print on these ads. They expect you to do the research and find it yourself. But these are real ads. These are real things that people are trying to sell you. And this is the amount of transparency that there is when it comes down to APY and APR. This was my favorite example. 2%, 3%, 4%. What do they mean? I don't know. Let's go through it. 2% APY on your checking account for the first $15,000 in the account. What if you have more than $15,000? Well, the amount that you get depends. It will go from 2% to 0.4%. Some qualifications apply. At least this one tells you what the fine print is. 3% APY on the first $15,000 when bundled with a home or commercial loan. APY ranges from 3% to 0.5% on accounts over $15,000. Also, some qualifications apply. And then lastly, receive 4% cash back on debit card purchases. Some qualifications apply. This example, asterisk. This example, asterisk. This example, fine print. This example, asterisk. This example, asterisk. Guess what? There's fine print on everything. Where's the fine print? There is none. You have to ask them for it. Otherwise, you're not going to see it. That is how this works. And that is why I've given this presentation. Because interest rates are very commonly skewed to make the numbers seem more appealing to you as a consumer. Institutions will do this by advertising APR or APY, and only whichever one is the nicer number to you. However, both of these numbers try to give consumers the best and most real interest rates that they can expect. But the reality is that these numbers can be misleading because the terms of the loan or the sum conditions apply will greatly change the APR, APY, but more importantly, the underlying fees that you will have to deal with. To help us, institutions are legally required to list both APR and APY, as well as what fees are included in the APR. But finding it's not as easy as you may want. So whenever you decide to shop for loans or interest rates, always be sure to not just take the first person or the lowest number on the TV. Do your research, ask the questions. It is your right to know the real numbers that you're dealing with. Because when it comes down to it, if you take out a loan, it becomes your money and your liability. So it's incredibly important that you know what strings are attached with that money, how often you have to pay it back, where you pay it back to, the amount of interest they charge you, the fees that you have to pay up front, and what they'll charge you if you're not able to make your payments. So again, always ask questions, demand to see the real numbers, and do your research. Trust but verify, and when all else fails, talk to a professional. That's why they're there. I promised you I would show you all the APR calculator. So let's go and do that together, and then we will call it for today's webinar. We're going to take a $300,000 loan. We'll start off with a term of 10 years, and we'll go with a 2.75% interest rate. Upfront fees, $10,000. Probably about what you could expect. And we see here our interest rate goes from 2.75% to 3.46% APR. From this, we pay $43,000 in interest. Of that $43,000, we also pay another $10,000 in out-of-pocket fees. And we can see here that 85% of what we pay is paying back the principal, 3% is the fees, and 12% is the interest. What if we change this now to 30 years? Everything else is the same. Watch how this real APR changes to 3%. Because now, these upfront fees, instead of being 3%, they're now 2%. But the amount of interest we have to pay has also gone up by quite a bit. It's now from 12% up to 31%. So this tool here is a very interesting way to see exactly where your money is going. It uses the APR calculation, but again, APR is compounded monthly. So here you get to see exactly how those numbers are changing. And if you notice, they don't add on the interest. The interest isn't added on to the balance. The interest you just have to pay. The principal is the only thing that ever changes between the beginning and ending balance of every period. And if you scroll down, you can see all 30 years as your principal payments change, as well as your interest payments, where in the end, you end up owing $0, and in your last interest payment period, you pay off $2.80 in interest. I'm going to post this website in the chat right now, as well as if you are watching this video after it's recorded, you can find it down in the resources section in the description. But again, this was the end of our interest rate series. We have started with the federal interest rate. That was the beginning of all of this. The best interest rates you'll ever find are based on how low the federal interest rate is. From there, we talked about simple versus compound interest, how savings accounts work, and how making meaningful contributions towards paying off your loans or adding on to your contribution in a savings account or even a retirement plan can create massive, massive returns over a longer period of time. And then lastly today, we talked about interest rates as you will see them when it comes to buying a house, buying a car, or when it comes to getting a new credit card. They will throw around these magical words of APR and APY, but always with that little star at the very end of it. So now you know why they put that star there, and you know that if you want to get the real information, you're going to need to ask. But now you know the question to ask. So thank you all so much for bearing with me through these 3 webinars. It's been a pleasure to get to do this deep dive into the entire world of interest rates and the entire money market industry with you all. We will have another awesome members webinar next Tuesday, as well as next Friday. We're going to be starting a new series of classes. Topic still yet to be determined, but if there's something that you would like to hear about or anything that you would love to learn more about, please send us an email at support@sectorsmadesimple.com, because I'd love to hear from you what information we can help share to make investing or just understanding the financial world as a whole that much simpler for you. So again, please feel free to reach out, if nothing more, just to say hi and let us know how you're enjoying the webinars. But until Tuesday's members webinar or Friday webinar for everyone, we'll see you all very, very soon. Take care, everybody. Stay safe, and we'll see you all very soon. Bye.